Welcome to Renovate Ed, where we talk about all things home and renovation related. Hosted by Jennifer Goldsby, a renovation lending expert. Let's get renovated.
In today's episode, we're going to cover what I think every home buyer or homeowner who is looking to use renovation financing should know, and very few loan officers communicate. I call this my setting expectations conversation, and I have it with every home buyer or homeowner I talk to who is applying for a renovation loan to make sure they understand the importance of the loan, the process of what it looks like before they even apply. So I'm going to give you guys the inside scoop. Take it from me. We'll overview the process, exactly what kind of financing this is, what does it look and feel like. We're going to answer a ton of questions in this episode. So let's start with the question, what is a renovation loan? A renovation loan can be used for one of two purposes. If you're purchasing a property, it can be used to purchase the property and pay for that property in addition to the costs for renovating the property. You can roll it all into one loan, purchase price and renovation costs. If you already own a home, whether or not it has a mortgage on it, you could own it free and clear, or maybe it's already mortgaged. If it's already mortgaged, we're going to pay off the existing mortgage. In either case, free and clear or mortgaged, we're going to give you additional monies, roll that into the loan to cover the costs of renovation. It's one single loan, so you'll have one monthly payment each month. And I do find that some have a little confusion over that. There are some individuals who contact me thinking that I'm going to offer a second mortgage, right? They've got to find one mortgage to buy the house, and then I'll give them the second mortgage to renovate it. But that's not true. It's just one first lien mortgage with one monthly payment. Very, very convenient, very easy. Loan amounts. Let's chat about loan amounts for a moment. The maximum loan amount allowed is going to be based on the county limit, and it's going to be dependent on whether it's a conventional loan, an FHA loan, a USDA loan. I'm going to say this, but there's always the exception. VA typically doesn't have a loan limit. There's another formula for that. So it just depends on whether or not you've used your VA benefits before and how much you have left. So there's a little ambiguity there on the VA side, but for all the other loan types, there is a defined maximum based on the county where the property is located. Talk to your loan officer, figure out what that maximum is. Most of the time we can do these projects without a problem, but there are occasions where you need too much and we'll be over the county limit and you'd have to bring the difference to closing, and that could eliminate using renovation loans as an option for some individuals who maybe need what would be more appropriate jumbo renovation financing, and that's pretty tough to find out there in the market. Now let's chat about credit scores. Most lenders are going to have a minimum credit score requirement. With Diamond, it's 620. There are some that I have seen, few, but some. They do exist out there that will go down to 580. But for the most part, the majority of those I know of, they're looking for a 620 or more. So if you can find that 580, you'd be doing real good. It's a tough find out there in the market. Let's compare the different renovation loans that are available, and I've touched on it a little bit, but I'm going to tell you what kinds of renovation loans are out there, and then I'm going to send you to the RENO-GAL.com if you want to learn more. So there are conventional renovation loans. Those are going to come from either Fannie or Freddie. Fannie Mae calls their renovation loan the Homestyle Renovation, and they have Homestyle Energy as well. Freddie Mac uses Choice Renovation, Choice Reno Express, or Green Choice. Green Choice is their version of a renovation loan for energy improvements. Then you've got the FHA loans. There is the FHA 203K Standard and an FHA 203K Limited. USDA has a couple of renovation loans. Now, they have a very long name for their program, USDA Rehabilitation and Repair Loans. There are rehabilitation and repair loans for structural repairs or repairs greater than $35,000, or rehabilitation and repair loans for non-structural repairs less than $35,000. And finally, you've got the VA alterations and repairs. The USDA products and the VA program, those are pretty difficult to find in the market. Not impossible. There are a few lenders nationwide that offer renovation loans at all. There are even fewer that offer anything beyond conventional and FHA. So those are the different types of renovation loans that are available on the market. And there's always an exception to every exception in the mortgage industry. It is possible that there are some maybe banks or credit unions that have a portfolio renovation loan as well. I would be remiss if I didn't mention that. There are pros and cons to each. Again, I'll encourage you to visit the RENO-GAL.com if you want to learn more about each individual loan program, but I'll give you an example. Fannie Mae Homestyle, a program I love. I love to use that program. It's fantastic financing, but they don't allow you to finance more than 75% of the property's value after the renovation has been completed to go towards the renovation costs. That's a mouthful. Typically speaking, this isn't always the case, but typically speaking, all of these programs that we've been talking about, they're for properties that you intend to live in. So I think I probably should share that. Yes, on the conventional side, you can technically finance second homes and investment properties, but I'll tell you, when it comes down to pricing, a lot of times it's very difficult to make a qualified mortgage in order to close a second home or investment property. Not impossible, it's just trying. So there may be times when you simply can't find the financing. You know what, I like to think of it this way. You've got one side of the industry, we'll call it FIFA, FHFA, that oversees Fannie and Freddie. And they say on paper, yep, you could do primary residences, second homes, and you can do investment properties. And then on the other side, you've got the pricing. They hit those second homes and the investment homes so high on the loan level price adjustments that we're not able to legally make a loan, a qualified mortgage. So it's almost like they're saying, hey, we don't really want to play in that sandbox anymore. And maybe with the changes that are coming down the pike, we'll see more flexibility in that area as time rolls on. But for the moment, right now, although on paper, second homes and investment properties are allowed on the conventional side, they're really tough to do because the pricing gets hit so hard. So all that said, single-family residences are pretty easy to finance using renovation financing. Multi-units, certainly possible. Lenders may have overlay. Most lenders, I should hope, would allow for warrantable condos, maybe modular homes. You might have more difficulty with manufactured homes. Here at Diamond, we'll do all of the above, but manufactured homes in combination with renovation financing is a pretty tough find all around, just industry-wide. All right, let's move on to loan processing, give you an idea of what this looks like, and talk a little bit about the timeline too. Most mortgages can be closed within 30 days. When people come to me and they ask about renovation financing, I always tell them, both the buyers and the realtors, that we need 60 days to close the loan. Do I, as the lender, need 60 days? No. But it's going to take you, the buyer, some time to find a contractor and get a bid from a contractor. Contractors are extremely busy and they're not the greatest at paperwork. There are some, granted, that have all of those credentials, the licensing, the insurance, the W-9s, the workers' comp at their fingertips. But for the most part, and look, I've been doing this 20 plus years, the vast majority, it takes quite a while to get that paperwork out of them. It's a bit of a hassle to them. It's an inconvenience. And a lot of them are spending their time out in the field. They're working on jobs during the day. They're handling paperwork in the evenings and on the weekend. I ask for the extra 30 days because I want to give you, the home buyer, or you, the homeowner, time to go out and find a contractor. And for us, you don't have to hunt down the credentials, but for us to hunt down the credentials from the contractor and to get a bid. I build in that extra 30 days strictly for you to give you a little breathing room. Certainly, we've had some instances where contractors have gotten us what we need very speedily, and we've been able to close loans in about 30 days. My industry average is about 42 business days to get loans closed. Not too bad, but we do ask for 60 days. So keep that in mind when you're writing your purchase contract. Don't write a 30-day contract. We're going to blow right past that deadline. I also want to share too, as I mentioned, that contractors are out in the field during the day and they work on paperwork at night and the evenings. That's somewhat typical of consultants as well. So if your loan needs a consultant, requires a consultant, we're now dependent on a couple third parties to get us the paperwork that we need. And it doesn't come overnight. It's not a quick process. I mention that to share that there are challenges with rush requests. So if you squander your time at the beginning of the transaction, we can't make up the time on the back end as a lender to try to hit a closing date. Be mindful, from the day you ink your purchase agreement, the clock is ticking. You need to get out there very quickly, find a contractor, and get a bid. So to give you an overall high-level overview of what this process looks like, you get pre-qualified if you're a home buyer. If you're a homeowner, don't worry about the pre-qualification stage, but you get pre-qualified. You go out, you shop for your home, your offer is accepted. and you need to find a contractor as quickly as possible and get a bid as quickly as possible. Yeah, I just told you that we build in a 30-day cushion for that. Let me tell you, that 30 days flies by when you think in terms of, oh, I got to meet this contractor out here on Monday, and then I'm meeting another one out there on Wednesday, and then I've got a third appointment on Thursday. Before you know it, a couple weeks have passed, and maybe they show up, maybe they don't show up, and you got to reschedule for the following week. And I mean, it just happens, right? So, yep. I'm building in 30 days for you to find a contractor and get a bid, but that time flies. During that time after we get the bid, that's usually when I like to engage a consultant if one needs to be used. After we get the consultant's report, we order the appraisal. A lot of times that's when I start talking to individuals about locking in their interest rate too. If we lock your rate in too early and it takes you longer than you expected to find a contractor and get a bid, we're going to blow the lock, and then extension fees are going to start piling up. I don't like to do that. So if the market is agreeable, it's not super volatile, then I tend to have a rate lock conversation at about the time we get the appraisal in. Appraisal comes in, we submit the loan to underwriting, clear all conditions, and close the loan. It's after the loan is closed that renovations can begin. It makes sense if it's a purchase deal, you don't own the home, don't do any work. But it's particularly important if you are a homeowner and you're refinancing to know that you cannot begin your renovation project until after the loan has closed. I always say, don't swing a hammer, don't go out and buy any materials. None of that will be reimbursable. Everything must wait and begin after closing. I on occasion have been asked by homeowners, hey, I know we're closing next week, but this weekend is a holiday weekend and there's a sale going on. I'd like to go get my appliances this weekend while they're on sale. Can I do that? I sympathize, but no, you can't purchase your materials. You can't do anything, no demo, nothing before the loan closes. So let me emphasize that all purchases and labor has to be performed after loan closing. Now let's talk about contractors. Many lenders and most programs are going to require or at least favor one general contractor managing the project. Could there be multiple contractors involved? Sure. Talk to your lender, make sure they allow it. I like to use the example of a general contractor who's taken on a project with a bunch of interior improvements, maybe some cosmetic stuff, kitchen remodel, bathroom remodel, flooring paint, maybe even some exterior work. Maybe they're replacing some siding and possibly even the roof, but they may not have a well or septic sub. So if you don't have connection there, a relationship there where that general contractor has a sub that can come out and, I don't know, dig a new well or repair or replace the septic, then that might be an instance where it makes sense to have two contractors. And the beautiful thing about that example is that those contractors can work independent of one another. The well and septic guys, they don't have anything to do with what's going on at the house, right? So I don't have to wait for the general contractor to do any of the work inside to pay a well or septic sub. It's a perfect example of when you might see more than one contractor. Where that becomes harder to do, and I've seen homeowners push for this, I have never seen it work out smoothly. Usually at the end of the deal, everybody's at one another's throats. So I've certainly seen homeowners who say, okay, I got my GC, but he can handle everything, but I want to use my own plumber and my own electrician. Well, here's the problem with that. With the renovation loans, you only get so many draws, right? So they all kind of have to work together to make sure that they get paid timely within that certain amount of draws. If you've got a plumber who doesn't typically work with this GC, doesn't have a relationship with them, they're going to be chomping at the bit to get paid, and we're not going to be able to pay them, for example, until the plumbing work is done, the city inspector comes out and looks at it, then you got to put your drywall on, then you got to slap some paint on, and now that draw, we can pay all of those contractors together. It doesn't always work out that way, but I see it often working out that way where we have to cram a bunch of work into a limited number of draws, which means they kind of have to share. And let me tell you, those contractors, when they get done with their work, they want to get paid. They do not like to wait. So if Mr. Plumber has to wait on Mr. GC to finish drywall and paint to get paid, he's not going to be a happy camper. That's just an example that I use because it's one I've seen the most often. Check with your lender. Make sure they even allow more than one contractor. And then, that way you'll know how to proceed. And I got to tell you guys, homeowners, home buyers, it really doesn't pay to try to hire your own folks to do mechanicals or certain things. I've seen it over and over and over again. People think that they're saving money, but in the end, it's always better to rely on your general contractor and the relationships that he or she has established with their subcontractors. Things go a whole lot smoother. The project progresses more quickly. We don't have the squabbles over payment. And we also don't have something else I see when a homeowner is insistent upon using a subcontractor of their choosing rather than their GCs. Oftentimes the quality of work isn't maybe what the GC would come to expect. I've seen this happen time and time again, where the subcontractors, especially if they're mechanical contractors, they're not passing city inspections or county inspections, town inspections, whoever the municipality is who's overseeing the permits, fails over and over and over again. So it really always pays to just rely on your GC, trust your GC, let them use the subcontractors that they have an established relationship with. Whoever the GC is, we're going to be checking their credentials. It's required. We're going to need to see licensing, liability coverage, workers' compensation. We'll need a signed W-9. There are some lenders who will do credit or background checks. Diamond is not one of them. We don't do that. But we do ask for, I'll call it a profile form to be filled out. They have got to sign an auth and release. So there are a few things that we're going to want to see from them. If the property was built prior to 1978 and lead-based paint is a concern, if any paint is going to be disturbed, and I'm generalizing a little bit here for the sake of time, but if there is a concern that lead-based paint is going to be disturbed, then they may need to show us their lead-based paint certification. Same goes with mold or asbestos or radon. If there's a special type of certification that's required to get the job done, we're going to want to see those certifications as well. And before I move on, there are some homeowners, home buyers who are contractors themselves who may wish to do some work themselves. It is tough to find a lender that allows for DIY, do-it-yourself, or self-help. Be sure that's one of the first questions you ask when you talk to your mortgage loan officer. Here at Diamond, we allow it as per HUD guidelines or conventional guidelines. Really isn't allowed on USDA or VA loans, but there are some restrictions. So ask about those restrictions. Now let's talk about budgeting and specifically a contingency reserve. If you are obtaining renovation financing, probably your lender is going to require a contingency reserve. I don't know too many who allow it to be waived. This is a cushion for unforeseen or unexpected repairs that pop up during renovation. The standard is to use 10% of your contractor's bid. If utilities are not on and functioning, usually they'll pump that up to 15%. In some instances, depending on the loan program, they may ask for as much as 20% of your contractor's bid to be financed into a contingency reserve. If you don't need that contingency reserve and you don't have to dip into it, great. Whatever's left over is applied as a principal reduction unless you have self-funded it. Let's say you've got a $100,000 bid, contingency is 10%. You bring 10 grand into closing to cover the contingency, don't need it, don't use it, then we can reimburse you the 10 grand. But if you didn't self-fund it, whatever's left over is going to be applied as a principal reduction. It's pretty neat that some of these renovation loans, they allow that contingency reserve to be used for discretionary purposes too. Not all of the loans, but some of them will allow you to dip into that. If the project is nearing completion, you haven't touched it or there's some money left in there and you want to do something extra. So maybe a new front entryway door wasn't in your contractor's bid from the go, but you've got money left over in contingency, project's almost done. If you want to use those extra funds to install a new front entryway door, talk to your lender first. Don't spend money without asking, but if it's one of the loan programs that allows for discretionary use, you may be able to do that. Timeline. We talked about the closing, 60 days to close, right? Now your loan is closed. What does that timeline look like? Well, again, I want to emphasize that no work should be performed before loan closing, but once the loan does close, you need to go out and pull your permits. So make sure you know who's doing that. I've seen instances where projects are completely stalled because the contractor thinks that the homeowner applied for permits and the homeowner thinks the contractor's responsible for doing that. Nobody's talking and they're both laboring under the assumption the other person went and applied for permits and nobody did it, right? So be sure you chat with your contractor and you have identified who's responsible for going out and getting permits. There are some municipalities that require the contractor to do it because in order to pull the permit, you've got to prove licensing or registration. Make sure you know who's pulling permits, how much they're going to cost. Usually lenders will give you that money at closing, so you've got it in hand. Go pull those permits right after closing before you start any work. I like to encourage everybody to pull all the permits at once immediately after closing. It's just easier that way. And then know that the work needs to start within 30 days of closing and should continue until it's completed without any 30 consecutive day stop. in the work. What do I mean by that? Let's say your loan closes in December and the anticipated completion date's in May. Well, the work should be ongoing from December to May without any 30-day long pauses in that work. The only exception to that is if something happens that's beyond your control. For example, maybe there's a winter storm, maybe there's some deeply cold weather and you can't get to the exterior work, so you've got to wait till spring. I mean, we understand those sorts of things. Just talk to your lender about that when that happens. And then in terms of the runway, how long you have to complete your project. If it's an FHA standard loan, you've got 12 months to complete it from closing. If it's an FHA limited, you've got 9 months, USDA 6 months, VA. That's going to vary lender to lender. Again, many lenders are going to want to see those projects done in 4 months or less. And then on your conventional stuff, I think you're going to see some lender overlay. So on record, you've got about 15 months, but most lenders are going to want to see those projects done in 12 months or less. Here at Diamond, we ask for no longer than 9 months on the conventional stuff, but if we need to do extensions, we will. There are some instances where somebody's looking at a property, or maybe they've inherited a property that is uninhabitable. It's been vacant for a period of time, or somebody vacated it and you can't believe anybody lived there. It's just not habitable. In instances like that, there are some loan programs that would allow you to finance a few mortgage payments into your loan while you're waiting for your house to be renovated, at least to the extent that you can move into it. So by way of example, let's say you've got a massive gut job ahead of you. You've inherited a property. You own it free and clear. It's been vacant for a number of years, and it's going to take your contractor 6 months to at least get it in a condition where you can move in, and then he can wrap up the finishes while you're there. In that instance, if you select a loan program, and most of them that would cover that type of a project, would allow you to finance up to 6 months mortgage payments. So you don't have to worry about making your rental payment or your housing payment wherever you're at, plus your new mortgage payment. And that's a nice little feature, something that you can use in the situation when it calls for it. So I want to talk a little bit about the draw process, and I'm not going to get too detailed on that because it varies so much loan to loan, but I want to chat about the draw process and then maybe share some warnings and best practices and wrap things up. I would say for most renovation loan programs, we're able to give the contractor a little something up front to get the job started, but that is not true for every renovation program. Well, I feel like a broken record, but I'm going to tell you to go to the RENO-GAL.com if you want to learn more about the draw process for each of the renovation loan types that are out there. Suffice it to say, the FHA 203K standard or the USDA for structural repairs, those are two I could think of where you may not get an initial deposit to give to the contractor at closing. In those cases, though, what we might be able to do is pay a supplier or manufacturer, a vendor. If there are any special order items, we could put a 50% deposit. Or if you've paid for materials from a supplier or manufacturer or vendor and you pay for them in whole, we can make you whole. We can reimburse you for that. So there are some conditions around materials draws for a couple of the loan programs. For most of the others, we can give an initial deposit. But that's important for a contractor to know, because if they're depending on an initial deposit to get your project started, they're going to be unhappily surprised if after closing, they don't get any money in hand. They're going to have to juggle some projects, juggle some funds around. So that's a really important conversation to have with a contractor, specifically on an FHA 203K loan. The rest of the draws, they work like a reimbursement program. Work needs to be completed. The work is inspected. The contractor gets paid. They do more work. Their work is inspected. Then they get paid, and so forth. There are limitations on the number of draws that they can have per loan program, so that's good to know. And on some of the loan programs that have the multiple draws drawn out over a period of time, for each draw, they're going to enforce a 10% holdback. Let me give you an example here. Contractor submits draw number 3, $20,000. When we get that draw, we're going to order an inspection. The inspection report comes back and it's clean. We actually go to disperse that draw. We're going to take 10% off the top, so $2,000 off the top. That means we're only paying out $18,000 even though we asked for $20,000. All of those withholdings are held until the final draw. We pay the final draw in full at 100% of whatever the contractor requests, plus all the previously withheld holdbacks and maybe any contingency requests or change orders that need to be processed that haven't yet been processed. So the draw process is very, very important when you're speaking with your contractor. We don't expect you guys to remember all of this or set those expectations with your contractor. Your loan officer or your lender can do that. Many lenders, when they issue payments, they're going to issue dual party checks made payable to you, the homeowner, and your contractor. That could get a little messy, especially if it's a larger check. Banks are kind of funny. I used to work for a bank, so it might require both parties going in and showing ID to cash that check. It's just a pain in the tush. If your lender allows it, and you're agreeable to it, you could sign off on each draw and say, yep, it's okay for you to pay my contractor directly. Some lenders can wire or pay via ACH. Others will cut a check. It varies lender to lender, so make sure you understand that process as well. And you may want to ask how long it's going to take for your contractor to get paid. Now, HUD requires that the disbursement be made within 5 business days, so the clock is ticking there. I know we run about 5 to 7 days, so that's 5 business days, and oftentimes we can do it a whole lot quicker than that, but I like to set the expectation of about 5 business days or 5 to 7 calendar days. But I have heard some horror stories. There are some lenders out there. I've heard contractors complaining about 30-day turn times to get paid, and that's a little ridiculous in my opinion, but it's a good thing to know as a consumer so you can ask your lender, what's your average turn time to get contractors paid when they request a draw? All right, warnings, best practices. Folks, I know when you buy a house, it's your house, you own it. You should be able to do whatever you want to do to that house. I get it. But when you're using renovation financing, we have consultants or appraisers who are going out there, inspectors who are going out there to look at the job to make sure the work is being completed satisfactorily. And some of them, they don't care if you're working on a side project that wasn't included in the loan. If there's any ongoing construction on the property, they're not going to sign off on the final inspection. And that's a problem because it's going to delay our payment to the contractor. Your contractor is not going to be too happy. I like to encourage homeowners to avoid any concurrent projects. Hold off on your side projects that you want to do until your contractor is done with whatever they're doing. We've got that final inspection in hand and we've paid out that final draw. If you can't hold off, if maybe some of the work overlaps with what your contractor is doing, then just make sure that your work is done when your contractor is done. And I mean every last thing, every outlet cover, every piece of trim work, baseboard, every light fixture, painting, the whole nine. Make sure it's all done, job site's clean when the inspector comes out to do the final inspection. Otherwise, we risk them not signing off on the final inspection and we delay that final payment to the contractor. I hate to see that happen. Another thing I can warn you about, whatever bid you provide to your lender before loan closing, from whatever contractor who provides that bid, that's the work that needs to be done after closing by the same contractor. I've seen some folks try to work the system where they will go out and they'll get a highball bid, right? So they bring us this high bid and then in their mind think, okay, I'm going to immediately fire this guy after closing. I'm going to hire the lower bid guy and I'll pocket the difference. It does not work that way. We never give money to the homeowner. It always goes to the homeowner and contractor or directly to the contractor. You will not be able to pocket the difference. And we see a lot of issues when that happens because maybe the second contractor isn't as qualified as the first contractor. So if you intend to do that, to switch it out immediately after closing, just know that we're going to vet that new contractor. They're going to have to meet all of the same qualifications and they're going to have to work within the confines of that original contractor's budget and timeline. So keep that in mind. It's a really, really poor practice. I hate to see it happen. And lastly, do not fire your contractor without first consulting your lender. You're not married to the contractor. Yes, you can terminate that relationship, but you guys are signing legal paperwork and there are certain steps that need to be taken in order to terminate the relationship, to sever that contract. So we want to walk you through those steps. For example, you may be required to write a letter to the contractor and give them 10 days to rectify whatever deficiencies there are. That may be a requirement of your contract. We want to walk you through that process and make sure that you're taking all the steps that are required so that there's no backlash on you or us, of course. And also, all work needs to stop. So never fire a contractor and have somebody come out without talking to your lender because the job must stop. We need to get an inspector out there to inspect the work and document how much work has been done so we know what's owed to the old contractor before we can have the new contractor come in and pick up where the other one left off. Keep in mind, you only have one budget. There's only so much money in that renovation escrow account. Whoever you hire to come in and finish the job, they have to be able to finish it within the budget that you have and the timeline that's allowed. We talked an awful lot today about renovation loans and what to expect. We did a high-level overview of the process and each step, talked about some pros and cons, what you can or can't finance in terms of fees or even the types of repairs. We talked about the properties that are eligible and the timeline and the contractor qualifications. We covered a lot of ground here. If you have any questions about these things that we've talked about, make sure you jot them down and chat with your loan officer about them. Do your due diligence before you apply for your loan. There's nothing wrong with recognizing the fact that you've picked the wrong lender and switching. I hate to encourage that practice, but the fact of the matter is you need to work with someone with experience. So if you sign on with a lender, you do a loan application, and you know things are not going right, they're not answering the phone, they can't answer any of your questions, you've made a mistake, you do your shopping, find the right lender. It's going to make the difference between a smooth process or a very trying one. Of course, I'm always happy to answer any questions. Visit my website. I've mentioned a couple times now, the RENO-GAL.com. Reach out, leave me a message there. I'm happy to answer any questions that you have. There are some resources on that website as well that may prove to be handy. So do your due diligence, work with the right lender, don't be afraid to ask questions, and your project should go very smoothly.
Now the legalese required to appease attorneys, compliance officers, and regulators. This podcast is hosted by Jennifer Goldsby, NMLS number 591226, Vice President, Renovation Lending. The topics discussed herein reflect my personal opinion. They do not represent the opinions of Diamond Residential Mortgage Corporation and its management. Discussions about loan programs in this podcast are not a commitment to make a loan. Programs, approvals, rates, fees, and loan terms are subject to loan applications, credit risk, appraisal evaluation, underwriting guidelines, and other lending or qualification criteria and limitations, and are subject to change without notice. Not all products are available in all states. Not all borrowers will qualify. Diamond Residential Mortgage Corporation, 582 Oakwood Avenue, Lake Forest, Illinois, 60045 847-244-9301. NMLS number 1-86805. For licensing information, go to nmlsconsumerAccess.org/entity-details.aspx/company/186805. Equal housing opportunity. Diamond Residential Mortgage Corporation is not affiliated with or acting on behalf of or at the direction of FHA, VA, USDA, Fannie Mae, Freddie Mac, or any governmental body or agency.